If you're looking to buy Mullen Automotive stock, then keep watching this video because we're going to look at the company's recent news, how the market's treating the company, and what are the technicals telling us. And most importantly, what is the best trading approach? As the market is still very volatile for the moment, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Mullen Automotive has a significant swing over the past few months and managed to maintain itself mostly around the $1 level. The stock has shown a clear tendency to hold the ground around that price point and is looking for catalysts. In fact, we can certainly start wondering if the sector-wide sell-off that lasted for the better part of a year so far is not behind us, and whether the stock might start drifting around the same level until the market believes that the stock price should rise once again, whether it's because of sector-wide reasons or company-specific fundamentals. Previously, I mentioned how the week ahead of us might be important, and that if Mullen manages to hold the line there, that would be a strong sign that the future will look brighter than the present. And let's just hope that Mullen will begin to communicate to its shareholders with more transparency and reduce the amount of bad surprises that it can avoid. The last element to consider is the sector-wide environment, which has likely changed significantly over the past week or so, I would say, as the central bank rates have paused their ascension for now, which provided a new perspective for the growth stocks, at least in the short term. Now, let's also take a look at the technicals. The trading volume of Mullen has recently been around 22 million shares versus an average volume of 62 million shares. Over the previous 52-week period, the price fluctuated between 52 cents and $15.90. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be a possibility for the trend reversal or breakthrough if the difference is very large as well. Like, for example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Mullen Automotive is currently around $362 million versus the enterprise value of around $112 million. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies might be the intangibles, meaning they're not items or stocks that a company can use to generate more income, but secondary items pledging for a brighter future, such as pledges for major contracts, schematics, intellectual properties, and brandings. In concrete terms, what this means is that there might be a huge difference between the market cap and the enterprise value depending on how those intangibles were valued, giving a false impression to the market participants that there's a huge discount between what the company is worth now and what it's trading at. It's also possible that the company itself was overvalued in the first place and that it has only deflated back to where it's supposed to be ever since. As we compare the current price to the historical price fluctuations, the stock is 227% higher than the 1-month low, 227% higher than the 3-month low, and 227% higher than the 52-week low. On the options market, which gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 204% versus a historical volatility of 115%. The put-call volume ratio is currently around 0.29. It is normal for stocks to also tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 8.2 thousand contracts a day, versus the 30-day average of 43,000. In terms of open interest, the most recent volume of open interest has been 559,000 contracts versus the 30-day average of 495,000 contracts. The option contracts are tools allowing traders to hedge their risk, increase their exposure with limited downside, or as a new revenue stream. They are derivative contracts based on the underlying security, giving traders the possibility to buy or sell the security at a predetermined strike price, helping limiting the potential downside. The put options allow selling at the strike price, usually chosen for an anticipated downturn, and the call options allow buying at the strike price, usually chosen for anticipated bullish run. In terms of the shareholder structure, institutional shareholders own 1.6% of the outstanding shares. The biggest shareholders include Vanguard, Citadel, and Susquehanna International. Usually, it's best to see some institutional participation when holding the stock long-term, because it offers a layer of stability and a token of reliability in the medium to long term. This means that the market is confident that it'll deliver value in the long term, which is an important factor to consider for investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there could be many exceptions to this rule, as there will always be great companies mostly owned by retail traders as well. Let's also take a look at the short interest on the stock as well, which is the number of positions that'll profit from failing stock price. The way it works is that short positions will borrow shares from brokers, selling them in the market and buy them back later, profiting from the difference between the two timings. If there are significant short interests, usually above 25 to 30%, there could be a potential for short squeezes, whereby traders will buy the stock up, forcing those with short positions to redeem their positions to buy further losses, which acts as a buy for the stock's price action. This is what people refer to as short squeeze, and it became a popular concept in the recent times, with stocks like GameStop and AMC being successfully short squeezed. The current short interest is around 13.6% of the total float, and 60% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, this could be a significant sign for a short squeeze. My recommendation is to commit a significant portion of the allocation in Mullen now, such as 50 to 60% of it, and to buy the remainder of the allocation over the next 6 months or so to manage the short-term volatilities. I would recommend to commit between 3 to 5% of your portfolio's capital in the stock, and would also recommend to split the allocation in batches of 20% at a time after the initial buy, so that you could purchase more in case of further retracements. Given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.